It's the first week is in the books, and we are really prepped to have an economic and earnings season report cards coming up. We did get some economic reports this week, and most importantly, we got a CPI report, and that's going to come through and set up some of the earnings reports we're going to get over the next several weeks.
Right. The CPI report came on Thursday. It was relatively benign. We saw the first drop since last summer, primarily driven by lower prices of gasoline and used cars, so that was a positive. Some people had been, I think, waiting to position themselves after that report. And so we saw a very strong week. We saw the S&P up almost 2%, NASDAQ up 3%, and small caps leading the way up more than 4%.
And so the true story is now, what is the Federal Reserve going to do? It's been the story, of course, of 2022. And either way, they're near the end of their rate hiking. We'll probably see something in February, very likely 25 to 50 basis points. And then we'll have to see if they pause and hold and see the data going forward.
Right. I mean, the market's expectation is they may, in fact, ease towards the back half of the year. That's not really our base case as an investment committee. But historically, what the Fed has done essentially is follow the yield on the 2-year Treasury note. And right now, with that forecasted increase of 25 basis points, as you mentioned, Dave, that puts them roughly in line with where the 2-year is. In fact, slightly higher. So the 2-year has done its job, essentially telling the Fed what to do.
Well, that's really the point. So, the bond king, Jeff Gundlach, made a lot of news this past week. And, of course, the old axiom is don't fight the Fed, but maybe the Fed's not in charge, according to Jeff Gundlach.
Right. Historically, he has a really great chart that we've included in our talking points for our wealth managers over the weekend. And you see that basically that 2-year yield has led Fed fund increases and decreases over time. The other thing that Gundlach said actually during a conference call that I thought was very interesting. Now, again, he's a bond manager, so he's probably talking his book to some degree, but he feels that bonds are an extraordinary value at current levels, whereas he does not believe the same is true for stocks. So he actually suggested that people ought to flip their allocation towards bonds relative to stocks. I'm not prepared to go that far.
He said it was a 60-40, not if it's more than that, but if it's 60-40 equity to bond, he thought maybe you overweight bonds and underweight equities was his point.
Right, and that may very well apply to someone who's retired, who's conservative, and is looking for a paycheck, because right now there are alternatives. The 1-year Treasury yield is north of 4%, first time we've said that in years. So that's a good situation for retirees. The question is, what is this Fed input going to do on earnings and growth of the economy going forward? We know they've been raising interest rates, and we know M2 growth has slowed. So the odds that inflation has peaked are very high, but it could be sticky in certain areas.
You made a really good point. One of my favorite macro guys, Jason Trennert, came up with a saying years ago called TINA, there is no alternative, which, we always used to joke, Danny, that was my Italian cousin. Yeah. Right, but now there is an alternative, as Derek points out, Terra. There is a reasonable alternative, and that's really what's happening. There is a spot now for fixed income that we haven't seen, as you pointed out, in decades.
Yeah, as an example, right now only 16% of the stocks in the S&P 500 yield more than 4%. That's the lowest number in 11 years. So when we were talking about equities being advantaged relative to fixed income, that was when interest rates were extraordinarily low and you could pick up higher dividend yields in the S&P plus the upside potential of stocks. That has flipped, and that's part of the reason Gundlach is suggesting that. So, as one looks at their portfolios, understand the fear and greed index, which was in the low 30s just a month ago, is now back to 61, the highest level we've seen since December. So it really is a good time to do, as you say, take a look at what you own and why you own it.